Good morning, everyone. John McNichol here, and welcome to Active Trading, Swing Trading for May 1st, 2018. Hope everyone's doing well, those of you that are live as well as listening to the archive session. Good morning to you, Bharat. Thanks for being here from Chicago. And here's our disclosures, folks. Remember, options are not suitable for all investors, as these special risks inherent to options trading may expose investors to potentially rapid and substantial losses. Carefully read the previously provided copy of characteristics and risks of standardized options. Spread straddles and other multi-leg option strategies can entail substantial transaction costs, include multiple commissions, which may impact any potential return. These are advanced option strategies and often involve greater and more complex risks than single-leg option trades. Investors should also consider contacting a tax advisor regarding the tax treatment applicable to spreads and other multi-leg option transactions. Now, in order to demonstrate the functionality of the platform, we need to use actual symbols. However, TD Ameritrade does not make recommendations or determine the suitability of any security or strategy for individual traders. Any investment decision you make in your self-directed account is solely your responsibility. Make note of transaction costs, commissions, and other fees are important factors and should be considered when evaluating any trade. Past performance of any security or strategy does not guarantee future results or success, as well as utilizing tools as probability analysis and backtesting. Information is theoretical, not guaranteed, does not reflect a degree of certainty of an event occurring. Along with backtesting, success in a backtesting strategy does not guarantee that that same strategy implemented today would produce similar results. And all investing involves risks, including the risk of loss. Now, while this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. And there's your Greeks. The impact of price on the value of the option, delta and gamma. Vega, the impact, the option sensitivity to volatility. And theta, the option sensitivity to time decay. All right, so let's see what we got going on with the market today here. I was glancing at the pre-market there. As some of you may know, or if not, something that you can incorporate into your desktop there. You have a quote column for a mark percent change. That can show you basically the percentage change overnight, or at least in the pre-market, based off of changes to the bid and ask prices. Now, when the market opens, certainly you can look at net change or net percentage change there. Percent change. So I'm going to move this up here. Right there, notice it's the same now as the market's open. So you can look at percent change from the market point on. But in pre-market there, on top of looking at the news, adding mark percent change, I can see what stocks may be moving into pre-market. If we go in and sort this, off the Dow Jones, Apple's up moderately. However, if you look at most of the stocks are down at the opening, with stocks such as Pfizer, Chevron, ExxonMobil, more to the downside, being off over 1%, along with McDonald's and Caterpillar there. So pretty broad as far as with some of the stocks are down, from pharma, energy, industrials, discretionary, and even staples there. Now, if we go ahead and take a look at on the S&P 500, it's going to bring that up. Not sure what the deal is here with Pan Air. The calculation seems to be off there. It's not off of 33%. However, Tapestry, formerly known as Coach, is off significantly at the opening there. Apparently beating earnings, but concerns, I guess, with some of their sales going forward there. Seagate's also off at the opening there, Seagate Technology. And going down the list, other brands such as Under Armour, Cummins, Noble, Ecolab on the chemical side. So quite a few stocks not just tied to any particular sector there. And looking at any stocks that are in the positive territory, AV, Fidelity National, Johnson Controls, a little positive Win Resorts. And so kind of a bit split on the S&P, as it looks like more stocks down than up at the morning. And looking at the NASDAQ, already mentioned about Seagate there. Liberty Interactive looks like it's off a bit, although pretty big spread that may not be necessarily reflective in the price there. Amgen. So a few areas in the pharma and bio are off. And as far as in the positive area, Akamai, Discovery Communications, NetEase, Skyworks in the positive there. Now, if we go ahead and take a look at the S&P, we've been discussing this in previous sessions, not just here in the swing trading, but also in the technically speaking session on Monday there, if you joined me there yesterday, is we've discussed more of the smaller bottom information that had broken out. Price blew back into that pattern. It has a tendency of happening, although from a stronger perspective, certainly broken resistance acting as new support would be more desirable for bullish traders. Prices did blow back, and on the bounce, notice from yesterday a swing failure. So what's a swing failure? Since this discussion is on swing trading, you know, the aspect of taking advantage of whether upward or downward swings. As an example here, we have an upward swing. I'm going to make this a little bit thicker here. Followed by a retracement, and it could be a smaller retracement such as a bull flag, which we had right here. Pullback of typically upwards of 3 to 5 days, although it could be smaller, could be a little bit longer. As this was reviewed last week, looking to see if there may be a bounce and looking for a follow-through swing. A successful swing is on a bounce when prices swing and take out a previous high. Now notice here prices retraced a bit more, rallied up, and found some congestion there. Resistance, support, acting as resistance again, rolled over, and we're seeing a little more follow-through here today. Now, if you do struggle on being able to identify some of these swing highs and swing lows, we do have a tool that we have shared with you in the past under your patterns. Come up here, go to patterns. You can make sure that show patterns is selected, and under select patterns, it's within the candles. We'll click on candles, and down on the bottom there, that Williams fractal. And a Williams fractal is intent is to basically plot some of the swings that'll appear on the chart. Now another cool thing, when I clicked on the help for that, notice it took us to the Learning Center, and another great feature, no longer do you need to drill down in the help section to find the Learning Center. It's now part of our education tab with one of the more recent updates there. And it took us right here to Williams fractal. And the point is looking at the previous bar, the forward bar, and basically plotting highs and low points in the swings. And it can be a bit of an educational tool on helping you identify those highs and lows. and possibly draw support and resistance to identify some of these patterns that we've discussed here over the last week. Now, if I go back and make sure we select that again, didn't save it there. And we'll apply. So notice here you can see these little tick marks, little chevrons. High, high, equal highs, horizontal resistance. Looking at low, lower low. Now notice here there are some higher lows here that a fractal did not capture there. That can happen when there's some bigger swings over the course of the last day and the previous day, or I should say previous day and the last day. But you can see that it picks up some of the major points right there. Now notice there's not a plot on here at the moment for this particular high. You know, it's not forward looking there. It's basically this bar would have to finish down for that to confirm that that is a lower high. All right, but hopefully some information that you can use there. Notice another thing as far as talking about support and resistance. You know, moving averages can act as areas of support and resistance. As we've discussed it with this example, the 55 period moving average, more of an intermediate trend, has generally been going more sideways to down, and price action over the last 1, 2, 3, 4, 5, 6, 7, 8 sessions has continued to stay down below that average and being in the lower range. Even though companies have been coming out with decent earnings, there's certainly some discussion that the market had previously priced in a lot of those earnings from the last quarter, and as we're going into another quarter here, that expectations going forward may not be quite as rosy. All right, so we can see that reflective on the S&P. Looking at the NASDAQ. So looking at some of the different indices is to have an idea of some of our market posture, whether one sees the market as being bullish, bearish, or being more neutral. Swing trades are typically more momentum based, so looking at an index, a sector, as well as individual stocks that are clearly in a trend, whether up or down, or breaking into a new trend, would be some of those candidates. However, notice when we do look at these indices that prices have been very much back and forth, moving averages more flat. And as we take a look at some of these patterns here on the NASDAQ, we still have that Williams fractal on here. Let's go ahead and kind of connect the dots. Getting ready to see if I can teach my 2-year-old granddaughter to do this. Kind of connect the dots there. So high, high resistance. Looking at the lows, low, support. Okay. So notice as we look at something like this, when there's a sharp move down in the trend and price action coming back and forth here, with a upward bias, some technicians refer to this as a rise and wedge, and there's been a few of these patterns in different sectors. I believe financials is one of them as well. And you know, with that weakness as the market and individual sectors fail to retrace back up to previous highs and begin to fail, that traders may look for a break on the downside of that pattern, starting off with swing failures and culminating in a break in support. Now, still early to tell. You know, got to be careful about preferential bias. There is resistance up here as well, and if price goes ahead and rallies up to the upper portion and break above, that would be more of a bullish reversal. A little more along the lines of a W pattern, as some technicians may observe there. And really, it's a matter of which way it breaks which would confirm that direction. Whereas price being in the middle of that range, more of an equal bias there. Short-term traders may attempt to trade down to that support. But notice it makes things a bit more confusing to short-term trade some of these markets when they're behaving this way, whereas in previous months where there is clearly more of an upward bias based off of moving averages, more smaller consolidations, and continued breakouts to trade in the direction of the trend. I'll notice another thing to consider too, as far as overall posture with the NASDAQ, is based off the pattern formed since the beginning of the year. High, higher high, lower highs, horizontal support around the 6,300 area. Some technicians would consider this to be more along the lines of a head and shoulders top, and that would be confirmed if prices break down below those previous lows. Okay. Now, these patterns, as you can see, don't occur overnight. They take some time, and it can take a little time before some of that posture changes. But nevertheless, price is still below some of the various moving averages there. Looking at the Dow, similar fashion there. More of a downward slope as far as lower highs. Prices attempt to break out, blew back into the reversal pattern. In the example, still below the 55-day moving average. Prices have rallied up, and a swing failure, as this is a lower high here, and rolling over once again. And finally, we'll look at the Russell. Now, interestingly, the Russell, even though it has been making lower highs since January, at least has attempted to reclaim some of those highs. It came in a closer range than some of the larger caps. Now, even though resistance has been falling, looking from support side, you can see more of the rise in support. Again, you can kind of get an idea of some of the patterns as the Russell kind of squeezes in. Averages, again, are kind of more sideways here, and so it's a bit more of a back and forth. So this was part of the view on looking at how the markets have behaved and not seeing very strong trends one way or the other. If you recall last week, we did put in a couple of practice trades. One was on American Express. Let's go and bring that up, which actually is closed out prior to this session here on our practice account. But let's just bring it up as an example of a review here. And this one was originally done on 4/24, where sold a 101 call and bought a 102. Now, let's go ahead and take a closer look at this here. And let's bring up American Express here for a sec here. So it looks a little askew from when it did this here. So in the case of American Express, this was back on the 24th. It actually didn't look... let's see, viewing on the trades on here. Looks off here. It looks like this was a call spread. that was a credit, but I thought I'd put this in as a debit spread. May have made a mistake on that one there. As we're looking for a moderate move higher. Also practice as far as with a stop, not a stop loss, but a limit order on there. And looks like that actually kind of triggered out at not that big of a move there. That was only for about 7 cents there, but did result in a now let's go and double check on that. It looked actually a little bit different from the last time I talked about it. My apologies on that. The other one was on Halliburton, and this one, let's see if we can bring up the trades on that. This was a call spread where we went ahead and bought the 52.50s at the money and sold the 53.5s. That ended up being essentially a 50 cent, about 48 cent debit there, and looking to basically capture the other 50 cents on that dollar wide. And if you go and look at the chart on it, you know, Halliburton has gone up slightly. Now, volatility's gone up a little bit as well, but the intention is that if price is above 53.50, in this case, I believe it would be over the next 2 weeks on 18 May, then this would be a maximum gain. In a case on American Express, the idea was the same deal as far as looking for a bounce for price to trade up. American Express so far has failed a little bit. And again, I'll have to go back and look at that trade, see what I did wrong on that. Okay. Now again, these are all practice trades, even though it says real time here. This is a demo account, and these are being used for illustrative examples. Let's see if we can take a look at another one that we can go ahead and practice here today too. Looking at some of the weakness that we've seen in the market, including seeing some of the pharma stocks being down there. Bring up Amgen as an example. Now, remember the patterns that we had looked at on some of the market here. Sharp move down, seeing price action rising here, seeing support rising here, more of a rise and wedge. And notice in this case, at least intraday, price is broken below that. And certainly if someone had a whether a buy stop on a put or a trigger to enter as price traded down, can attempt to capture that momentum. Now, there's no guarantee that prices would continue to fall, but notice again, find some resistance right there. What I was going to attempt to do is try and do another spread here. Now, price has moved a little, about $2 there. Certainly would have been more desirable to try and capture it right at the opening there, but certainly important to go over the concepts and seeing where the market is at there. So I'm going to go ahead and go to Trade tab. And looks like this may have adjusted a little bit here. Let's go ahead and take a look. So on the put side, looking around at the money, I think earlier was looking, before the market would have been around 172.50. Now it's around 170. Go ahead and let's see, we select buy, vertical here. In this example, about a 94-95 cent debit. If we hit on the confirm and send and take a look at it, well, let's actually go ahead and change it down to one contract for illustration purposes. So looking at this, basically the maximum profit is the difference between the spread, which is $2.50, and the debit. So in this case, $157 per contract. Now, what makes some of the spreads a bit more forgiving in this example is the break-even point is for this one is 169. So as long as the price is below 169, which is about a little more than $1 away, certainly have to factor in commissions and stuff, but price does not have to move as strongly to be profitable. And certainly the maximum gain is if it is below 167 at expiration, that would be a maximum gain. Okay. Now, this spread here, this is only about 10 days out there, so it doesn't give a lot of time. If one wants to have more time, they can go ahead and go a little further out here. Let me go ahead and this again here. Again, take a look at the chart. So essentially, for this example, over the next 10 days, the idea is that price would be below 167.5. Okay. And if it does that, that would be a maximum gain. If it's not, it could be a loss. It could be a maximum loss. Certainly, if it stays outside of that spread. So I'm going to go ahead and we'll practice putting this one through. Look at matter of position size. $86 per contract, based off of the size of the account. For practice, we'll risk 1%. It'll probably approximately be a little bit more on that, probably about 15. Okay, that's about all right. And we'll go ahead and send that through. Okay, again, short time horizon. So certainly if price does bounce and goes higher, there would be certainly less time for price to actually possibly roll back over again. If someone wanted to go a bit further out, or 17, or even upwards to around 40 or 50 days there, one can certainly do that as well. All right, so we got that in as a practice there. Let's see some other things that are going on here. Now we do have some of the script that we talk about in Technically Speaking. Some of you may already be familiar with this. If not, you can certainly join us on Technically Speaking on Mondays. That session is at, let's see, that would be noon or 2 p.m. Eastern Time. 2 p.m. Eastern Time, noon Mountain Time. And essentially all the script is doing is telling us where price is relative to, actually not just the price, but the moving averages relative to each other. So for instance, Amgen, both the 5 and the 13 are below the 55, supporting more of a negative sentiment as far as trend. So that should actually appear red. Notice, look at some of these other stocks on the NASDAQ. Let's say TRIP. Click on TRIP. You can see price action is below the 55. 5 and the 13 are below the 55. And you can see how previously price has broken an area of support. And that's typically what's likely to happen when moving averages are falling. So one who's looking for more bearish setups would ideally like to see prices below some of the major averages. Look for prices to rally up to resistance there. So for instance, in a case like TRIP, prices have broken support. There's a tendency that prices may trade up to that resistance, and if it fails, come back down. Now there is an earnings event coming out, so that can create a gap, whether prices may gap down or gap back up into the pattern. And speaking of patterns, seeing is that previous areas of support as well as resistance there. Kind of focus more on the recency here as far as previous highs. The distance from that support and resistance, just using a little rectangle tool here and projected down in this example, would give some traders an idea of potential price targets. So if prices come up and flag a little bit and bounce, then some traders may attempt to trade that down. Again, earnings can certainly create a gap that may gap it down or even gap it back up again. But just kind of illustrating on some of these different setups that one may find. Skyworks, much more of a downtrend. Look at some of these previous patterns here as, again, kind of that sharp move down. More of a rise and wedge here. And notice again, just connecting some of those dots right there, and another swing. So one to consider as you may be practicing bearish trades. And this is something that possibly a lot of you, depending on how long you've been trading or been pursuing some of the financial education, the markets have been very bullish for quite some time. And a lot of people are used to some of the more bullish upward swings in the market. And even what's occurring now, when considered on what's occurred, in the past, is still kind of a relative blip as you go back and look at other areas. I mean, there are some similarities as far as the range and volatility we're seeing now to where we seen back in prior to the 2016 election. Prior to that, other corrections may have been a bit smaller. Possibly, again, some of the volatility that we've seen also in 2011. Okay, so one has to learn, if they're a short-term trader, on how to kind of get through with some of these markets. And notice with some of our examples, we focused on relatively smaller moves, not necessarily swinging for the fences, so to speak, on looking at these big major swings, particularly on the upside. Now, however, as you look at some of the setups, including the one on Amgen, is when prices do break a intermediate support, possibly use an average here. Again, this is an example of a 55. Other traders may use a 50-period moving average. Something that represents that intermediate average is when price breaks that support and comes up to that area as resistance, that could possibly be another setup on the downside. Okay. Now, one thing as far as this week, we do have the Fed that's coming out. That's accessible. If you're trying to familiarize as far as with some of the news there, is making sure you can go to the Market Watch page and the calendar. All the various events, including earnings. You have to go ahead and just uncheck that and go to like Econo Day events. You can see some of the daily and weekly events. And some of the things that can build on whether some of the negative momentum that we've seen or change things around is seeing what things such as the GDP and some of those revisions are. If GDP is contracting, that points towards a slowdown in the economy. And it's incorporating a lot of information such as manufacturing. And so notice there's other things coming out on factory orders, on the services index. And if you look at some of these and you're not sure what it is, you should be able to, in the list, basically click on it. And SIPS and PMI Services Index is essentially purchasing activity in the service sector, seeing what people are spending. And it's one of the contributing factors on some of the stocks being down today, as not as many purchases occurring, as well as translating into not enough income coming across. Sorry, I got distracted there. Yeah, Ricardo, Friday Fed jobs report coming out, biggie. Yep, as you go in here, retail sales as well, along with employment there. So basically, as far as jobs and the money that's out there, personal incomes have gone up a bit, but haven't been spending as much as from the previous quarter there. So a lot of this coming out for the week. And the big one tomorrow is also the FOMC meeting announcement on discussing interest rates there. Okay. So all these could be drivers as far as market direction there. However, leading into that, we can see that, again, the bias has been a little more on the neutral to the downside there. Let's take a look at a few other things here. One of the things we're discussing, reviewing, and technically speaking, sector rotation. That can be a driver here too, as a lot of the different news stories come out, which may have been some good momentum players from the previous quarter, may not be the same over the next quarter. So what I'm going to do here is bring up some of the S&P sector indices here. And let's go ahead and pull this apart here. Bear with me. Now, these symbols are basically just numerical there. One would have to go ahead and customize a quote column and add a description there. That way you get an idea of what we're looking at here. Some traders may use ETFs or other instruments as proxies to different sectors. We have discussion on that in our splash on Mondays, and that is at 1 p.m. Eastern Time. So notice when we look at these sectors here, based off the moving averages and the crossovers here, notice a lot of the sectors are more in the negative. Materials, which continue to go down and have actually kind of pushed more out of a bear flag. Notice the same characteristics I mentioned. Prices have broken support, rallied up to trending resistance, may even be along the lines of a moving average, and have rolled over there. Industrials have broken support today. And I'll see how the thing ends and with the Fed, but that's a break support where industrials have taken out the lows over the last 2 months. Consumer staples still struggling, and staples again have pushed out of a bear flag here. Notice again, downward trend, prices rallying up to that resistance, in this case around the 55, and have rolled over. Financials, again, there's that rise in wedge mentioned. Prices have broken a little to the downside. They haven't broken down strongly. Probably still waiting to see what the Fed has to say and see if this continues on the downside or if we get a breakout to the upside. But notice some fairly consistent patterns here. Technology is more of a squeeze here. Kind of looking at it from a major standpoint. Now, one could go ahead and connect the lines back and forth, but also look at some of the horizontal areas as well. This is an example of prices breaking out and kind of fading. Telecom, again, pushing more out of a wedge. Energy has been one of the few that have been hanging more to the upside, breaking out positively, but fading over the last couple of sessions. Consumer discretionary still hanging at the resistance, although they've shown some strength, and Unfortunately, some of the companies today reporting have pulled it back off of that resistance, but keep an eye as we go into the end of the week with the Fed and also with the jobs report to see if discretionary stocks are able to break to the upside. So even though that there's weakness out there, there are a couple areas that have been hanging in there. Other areas, kind of more on the defensive side, healthcare, utilities, which has recently popped a little bit higher, and real estate kind of pushing up on that resistance there. So you can see a few areas are still waiting on the news, see where to go from that. Now, as we look at those different patterns there too, one can also go ahead and drill down and look for stocks that may be doing the same thing, and utilize the scan tab for that. In this example, looking for stocks at least over $10. On the study filter, add in an average volume. If one's doing options and stuff, may want to consider the more liquid and looking for tighter spreads, hence over 1 million shares. And go ahead and click on the scan there. And probably just left the list that was on there as it's trying to refresh now. Oh, there we go. Well, sometimes the script may take a little time for it to load up, depending on what tools that you're using. Let's look at TSCO, Tractor Supply. So we saw a lot of the industrials getting knocked around a bit. So here's a Tractor Supply after earnings has taken a big push higher. And notice it's pulled back, but hasn't pulled back dramatically. Let's go ahead and bring this out a little bit more. As we look at transitions of prices going from lower highs and going from lower lows to more equal lows here, and looking at the price action as far as resistance. With that earnings, prices broke out of that more of that bottom formation, signs of more of a bullish reversal. Prices above 55-day moving average, the 5 and the 13 are rising and getting above that 55. So certainly if the market continues being positive, may build into more momentum with a stock like this that is broken out. And again, just looking at it from a standpoint of relative strength, that the stock compared to the S&P has recently demonstrated stronger upward price movement. Now, that's not guaranteed to continue, as we can see in the past that the stock had lagged behind the S&P, fallen price, fallen relative strength. Things have slowed down. Price action started going more sideways, started building up some strength, leading into earnings. Relative strength rising, price breaking out. Okay. Let's for this example here. Well, this example is what some traders refer to as a flag, where price has moved sharply up, in this case after a breakout, and looking for a pullback, which may occur over a couple of days. Now, there's 1 day, this is 2 days right here. Some traders may look for the price to pull back a couple of days and then look for the break above the high, the low day. However, sometimes the market doesn't give you that opportunity when things are pretty strong with the market, and pullbacks may only be about a day or two. Now, we're not necessarily seeing that being the case right now with the broad market, but certainly this individual stock has held up a little bit better compared to what the market has done. So I'm going to show an example of a buy stop, okay, where looks to trigger if price trades above the high of the low day or a succeeding day. Now, currently the market's open, so this is going to end up potentially being a low day. Well, it is a low day compared to the previous day, but there's no idea that that price may continue pulling back. Again, that's why some traders may look for that 2 to 3 day pullback. But for illustrative purposes, I want to do an example of if price trades above a certain level to trigger an entry, set a stop, and also have a limit. Okay. So what we'll do for this example is take the previous move here. In this case, we'll take this move. Now I'm going to go from the resistance to this high right there. And if I go ahead and duplicate that, I'm going to also do it from the potential low day there. And that was a pretty good eyeball there. Looking at the previous swing and projecting that out. Now, just because price made a previous swing doesn't guarantee it's going to make that similar move. However, technicians will look at previous ranges, previous moves to project out another target. Okay, so in this case here, that would be approximately around the 74 level there. So let's go ahead and I'll put an example of 73.95, just kind of under that whole number. Some traders may look at previous whole numbers as resistance areas there, support areas, and may look to come in just underneath that. If we go ahead and take a look, and if I right-click on this as well, you can also display the price, whether on the left or the right. If I go and look at this previous high, 68.88, let's put 20 cents above that area there. So that would be 69.08. Mark that. And then the other thing we'll do is, as far as setting a stop, we'll put a stop a percentage below the low day. Now, again, we don't know if this is actually the low day, so this is just anticipating prices will break higher. What I'll do here for illustrative purposes is I'll set a stop 3% below 3% the low of this day. Now, some traders may use a 1% and have a tighter stop. We can always adjust the stop later, and we'll show you how to do that if we still have this in play next week. So kind of figuring that out. And another indicator while we have it on the chart is ATR. ATR is an indicator that basically looks at the average trading range over a period of time, in this case over the last 13 days. Someone may struggle as far as setting a stop, utilizing some volatility-based indicator to help with that. So for instance, if I put my cursor on the current value, it's about $2, and we'll just say $2.11. Okay, 2.11. So certainly it's proven from a short-term trader that stops would be at least outside of that average range. So possibly take a multiple of that, whether times 1.5, times 2, times whatever percentage that's reasonable for you. So if I go ahead and let's say we go ahead and take, we'll bring up a calculator here. Kind of zoom in on that. So for instance, right now the price is at $67.69. Now, if I went ahead and took a value of 2 on that, we'll take 211 times 2. That would be a risk of about $4.22. Now, if I go ahead and subtract that off of the current price as an example, let's mark that here. Now, for those of you that set stops based off support and resistance, which is a good reference point there, utilizing something like ATR may be helpful to see how it lines up with your setting stops there. So for instance, with this example, that would be a stop of 63.40. Let me go ahead and do that right there. Let's mark this here. So notice in this case, that 2 ATR basically puts you just below that 55-day moving average. Now, in the context of that, looking at marking this here so we can see all the prices there. Pull these indicators down. Now, as you look at that, that pretty much is more along the lines of a one-to-one type trade, risking one to make one. And that may be somewhat typical with like a 2 ATR, because it's basically putting you out twice of that daily range. If one wanted to have more of a tighter stop, take a smaller percentage. Again, 67, 64 times, let's do, actually I need to take that $2.11, which is the ATR, and let's multiply that by 1.5, so 1.5 times. That would be a risk of about $3, and we'll just say $3.17. We'll take 67, 64 minus $3.17. That would be 64.47. Okay, there you go right there. So with this information right here, what I'm going to do is I'm going to right click on the chart, and we can do buy custom with OCO bracket. Another session we'll talk a little more on conditional orders. This is 100 shares. And cost of trade for this practice example is about $7,000. Certainly falls within this example on the on net liquidation as far as on allocation there. As far as if one a position size based off of the stop loss, which again for this example was about $3. And pull this out here. Sorry, I struggle a little bit here with by having a larger screen, the bigger mouse so everyone else can see it. Sometimes I have a problem manipulating it on the chart. So let's look at a quick example of position size here, and we'll wrap this up. If I'm looking at a potential entry of 69.08 for our practice example, minus the stop loss price, 64.47, that comes out to being a risk of 69.08. I'm sorry, 69.08 is potential entry. Risk is about 461 per share. Difference between the potential entry price and the stop price. Now, we can take that and divide that into a percentage that you're willing to risk, and you have to be comfortable what you're willing to risk. Let's say an example here, 1%, that'd be $1,368. So if we take $1,368 divided by $4, I believe it was 61 cents. Sorry about that. Okay, 6447. Okay, great. Just want to make sure you got that right. Okay, 1368, which is 1%, divided by $4.61. That'd be 296 shares. Now, also need to make sure that that does not go over, as an example, how much you're willing to allocate on a particular trade. So I come back here on the trade tab, do a buy custom with OCO bracket, and plug in 296. Notice the allocation on that's about 20,000. Hence, this is why some traders may look at options, because it doesn't require as much equity here. I'm going to go ahead and reduce this for our purposes in half there. Now it's a little more in line as far as allocation there. And then we're going to go ahead and put the prices on here. Now, if we go and bring up the chart here, and let's potential entry price is 69.08. So on the trade tab, this would be a example of a stop limit. We'll leave it for the day, so it'll cancel if it does not place. Make sure I got that right there. I have a tendency to get a little dyslexic there. 69.08. And then the limit price is how much over, or actually, sorry, I made the mistake there. 69.08 is our stop. That's the trigger price. So when it goes above that level, it's going to trigger a limit order. You can specify a little bit above on how much more above you're willing to pay for that. I'll just put a little bit higher there. And then on the bracket side, these are going to be GTC for good till cancel. The limit price is going to be the target price. The stop is going to be the stop loss. So again, on trade 73.95. And then on the stop, that was 64.47. There you go. Now these are GTC, meaning that the orders will remain in effect until one triggers, and when triggers, it'll cancel the other one. So we'll go and we'll confirm and send that, and if price goes ahead and trades above that level, that will trigger. If not, it'll be canceled out. And you can look at the next day. If it continues pulling back, look to enter 20 cents above that high and adjust the stop and targets accordingly. So hopefully you learned a little something new today, folks. We went ahead and put in practice spread trade. Also went ahead and put in a practice swing trade here. Appreciate everyone's participation here. Remember, things that we looked at today were for illustrative and educational purposes only. Remember, options are not suitable for all investors. And also to demonstrate the functionality of the platform, we used actual symbols. However, TD Ameritrade does not make recommendations or determine suitability of any security or strategy for individual traders. Any investment decision you make in your self-directed account is solely your responsibility. So thank you so much, folks. Enjoy your day, and we'll talk to you again real soon. Bye now.